Energy Insights, your source for the latest energy analysis and market updates. So today we are looking to the recent developments in the energy sector. So starting from the Singapore's oil price shock and the monetary policy response, that would be the first segment of our today's episode. Then we have to look into the tech companies' approaches towards collaboration with the energy entities, and that will be covered under the segment 2. And in the last segment, we have to look into the market overview. So starting from our segment 1, that's the Singapore oil price shock and the monetary policy response in the energy market context. Singapore's tightening of monetary policy can be directly interpreted as a response to the transmission of the global oil price shocks into the domestic economy. The recent surge in crude oil and the LNG prices, driven by the geopolitical disruptions, act as a primary cost push factor, rapidly feeding into the electricity generation, transport, and the broader industrial costs. For an economy like Singapore, which is almost entirely dependent on the imported energy, this pass-through is both immediate and difficult to shield through conventional fiscal tools. In this context, the move by the Monetary Authority of Singapore to allow a faster appreciation of its currency serves as a direct hedge against the rising energy import costs. Since oil and LNG are globally priced in US dollars, a stronger Singapore dollar effectively lowers the domestic currency burden on these imports. This reduces the intensity of inflation without interfering with the physical flow of energies or distorting market-based pricing mechanism. It is in essence a financial adjustment to counter a physical commodity shock. The significance of this approach becomes more evident when viewed through the LNG market. Singapore operates as a regional trading and pricing hub. In a rising spot LNG prices, particularly in tight supply conditions, can significantly impact the procurement costs. By strengthening its currency, Singapore partially offsets these price increases, stabilizing input costs for power generation industry while maintaining its competitiveness as a trading hub. This is particularly important in the market where the Asian LNG demand remains sensitive to seasonal and geopolitical disruptions. At the same time, the policy avoids triggering of demand destruction in the energy sector, unlike interest rates hikes, which would suppress industrial activity and indirectly reduce the energy consumption. Exchange rate appreciation does not materially affect short-term energy demand. Industrial and power sector consumption remains largely intact, consuming continuity in economic activity, while the inflationary impact of the higher fuel cost is moderated. Overall, Singapore response reflects a strategic alignment between the monetary policy and energy market realities. Rather than trading and treating inflation as a purely domestic demand issue, it recognizes external origin of the shock and uses the exchange rate as a tool to absorb the volatility in the global oil and LNG prices. This allows the economy to remain a resilient energy market to function effectively and efficiently, and inflationary pressure to be contained without compromising the growth. So in the segment 2, we are looking to the Oracle Bloom Energy deal and the rise of the AI-driven power demand in the energy market. So this we have to look into under this segment. So the expansion of the partnership between the Oracle and the Bloom Energy reflects a structural shift in the global energy demand dynamics, where electricity consumption is increasingly being driven not by the traditional industrial growth but by AI and the hyperscale data infrastructure. Oracle's decision to scale its commitment to up to 2.8 gigawatt of the fuel cell capacity highlights how technology companies are now becoming a major marginal consumers in the electricity and the gas markets, particularly the United States. At the center of this development is the accelerating power requirement of the AI data centers, which are pushing grid system towards capacity constraints. Instead of relying solely on the centralized utilities, Oracle is increasingly turning to distributed energy solutions provided by the Bloom Energy. These fuel cell systems offer rapid deployment and on-site generation, allowing hyperscalers to bypass long interconnection queues and the bottlenecks in the traditional power infrastructure. This shift has important implications for the natural gas and the broader energy markets. Fuel cells, while more efficient at point of use, still rely on the natural gas or the hydrogen as an input fuel in many configurations. As a result, the rising deployment of such systems effectively creates a new layer of structured gas demand embedded within the digital infrastructure growth. Unlike the cyclical industrial demand, this AI-linked consumption is more persistent and capital-driven, which could tight and even tighten the medium-term gas balances, especially in the regions already facing constrained supply growth. The financial structuring of the deal also signals how energy procurement is evolving. The inclusion of a $400 million stock warrant alongside the expanded capacity agreement indicates that energy supply contracts are increasingly being bundled with the equity-linked financing mechanism. This blurred the line between the energy purchasing and the capital market positioning, where the securing power capacity is now tied to strategic ownership in the energy technology providers. From market perspective, this deployment reinforces a broader theme. Electricity is becoming a binding constraint for the digital expansion. As AI workload scales, the limiting factor is shifting from the compute chips to the power availability and delivery speed. This elevates the importance of the modular, fast deployment energy system like the fuel cells, gas peakers, and potentially small modular nuclear reactors in the long term. In essence, the Oracle in Bloom expansion is not just a corporate partnership, but a reflection of the deeper structured transition energy markets where the data growth is becoming primarily driven and the driver of the electricity and gas demand, reshaping investment flows across both the technology and energy sector. That's conclude our segment 2. Now we look into the market overview under the segment 3. So the global energy benchmark suggests a relatively stable pricing environment, but underlying market dynamics reveal significant fragmentation across the region and products. Crude futures are holding firm with WTI price at $91.52 today, which shows an increase of 0.26%. Similarly, Brent traded at $95.56 with an upward movement of 0.181%, indicating a balanced macro sentiment. However, the decline in Murban crude to $100.85 shows a downside movement of 2.4%, contrast with the sharp rise in the OPEC basket to $109.89, which an upward movement 4.38%, highlighting a widened differential within the key producing regions and crude slates. This divergence reflects a market increasingly driven by regional supply-demand imbalances rather than a unified global trend. The strength in the OPEC basket suggests tighter availability of the heavier and the medium sour grades, while the weakness in the Murban points to softer demand or increased competition in the Asian markets where pricing pressures remain evident. In refined products, the split trend continues. Gasoline price says edged lower to $3.34, lower than 34 cents, which is a downside movement of 7.17%, signaling either demand softness or sufficient inventory levels, particularly in the major consuming markets. In contrast, diesel rose to $3.67 per gallon, an upward movement 1.41%, indicating persistent tightness in the middle distillates, often linked to industrial activity, freight demand, and constrained refining capacity. Gas markets further reinforce the theme of the regional divergence. Henry Hub remains flat at $2.59, with the same price as yesterday, reflecting a well-supplied and balanced U.S. domestic market. Meanwhile, the European gas prices at TTF dropped sharply to $15 with a downside movement of 5.13%, suggesting easing supply concerns or demand side weakness. The LNG benchmarks in Asia, the JKM remains relatively stable at $19.42, a downside movement of 0.38%, pointing to steady but not aggressive demand in key import markets. At the equity level, the energy companies are increasingly reflecting this volatility and shifting expectations. On the New York Stock Exchange, the major oil companies such as the ExxonMobil and the Chevron have recently faced a downward pressure, with the decline exceeding 5% amid easing the geopolitical risk and falling crude prices. The broader S&P 500 energy sector has also weakened, dropping around 2.2% and erasing earlier gains tied to geopolitical tension. On the London Stock Exchange, energy majors such as the British Petroleum and Shell have mirrored this volatility, while the BP previously delivered strong gains of over 18% during the price rally phase. Recent sessions show pullbacks like the BP down to 2.4% and Shell to 2.7%, reflecting sensitivity to declining the crude momentum and shifting investors' expectation. Across other global exchanges, the trend remained consistent. Consistent energy equities that outperformed during the oil price spike are now correcting as market begins to price in a potential peak in energy prices and easing the supply risk. Analysts increasingly suggest a rotation away from the upstream producers toward refiners and diversified energy firms, reinforcing the view that the equity markets are anticipating softer commodity prices ahead. Overall, the convergence of the stable benchmark prices, regional physical market divergence, and weakening energy equities signaling a transition phase in the energy cycle where the markets are shifting from the geopolitically driven price spikes toward fundamentals driven normalization. That concludes today's in-depth analysis. If you found this useful, like and subscribe to the channel. Stay tuned to Energy Insight for your next episode. We will continue to bring you the actionable insights from the global energy markets. Thank you for watching Energy Insights.